Good afternoon and good evening, everyone. My name is Deepesh Patel, editor at Trade Finance Global and host of the podcast Trade Finance Talks. And thank you very much to the fantastic team at BAFT for an excellent few days at the BAFT Virtual Global Annual Meeting. And congratulations on your 100th anniversary as well. So today's session, we're talking about reinventing the wheel or back to the drawing board of supply chain finance. And now, obviously, as we know, payables or supply chain finance is a set of financing techniques that plays quite a critical role in enabling global trade, and it supports the success of both international and domestic supply chains. And the economic value of these activities, commercial activities, lies in the trillions each year. But there have been recent market events around the very big public implosion of a high-flying boutique finance firm. This could have the potential to irreversibly damage this really important set of financing techniques. But at its core, supply chain finance has the potential to strengthen supply chains and to help drive financing to MSMEs, particularly in developing and emerging markets. So today we're exploring the evolution of supply chain finance techniques from many different perspectives, highlighting its core principles. And I'm delighted to be joined by Stacey Facter, Senior Vice President of Trade Products at BAFT, Christian Hausherr, Chairman of the Global Supply Chain Finance Forum, and the European Supply Chain Finance Product Head at Deutsche Bank, and John Monaghan, Global Head of Working Capital Advisory at Citi, Treasury and Trade Solutions at Citibank. Welcome all, and thank you very much for joining. So, Stacey, let's take a bit of a step back, and can you explain what the benefits of supply chain finance is for corporates?
Absolutely. So from my perspective, the benefits are numerous for buyers and sellers alike. It offers the buyers the ability to extend their days payables outstanding without the adverse effect on the seller's day sales outstanding. So offering a win-win situation for both. So conquering DPO and DSO. It allows a much more predictable product availability for the buyer to avoid any disruptions in its supply chain activities, and allows sellers, SMEs alike, early payment through a new source of financing without using its facilities through its local lending banks, without the need to post collateral, and the advance many times at a better rate than it can do so in its local borrowing jurisdiction.
Thanks, Stacey. And John, just from the other perspective, what are the benefits of supply chain financing techniques for banks?
Thank you, Deepesh. As Stacey mentioned, there's a lot of benefits from a corporate side, but what about the benefits on the bank side? Certainly with banks like Citibank, transactional banking, providing payment solutions, liquidity solutions, and financing solutions to corporate clients is one of the most important parts of our business. Getting back to on the supply chain finance side and looking at over the years how it's moved from traditional letters of credit financing the supply chain now to more of an open account. What it allows us to do is service our clients and their supply chains, be it customers and or their vendors or suppliers, without actually having the customer relationship on either side of our corporate clients. So again, facilitating our ability to finance our target clients and their supply chains. The other aspect in terms of why it's important from a bank perspective is the asset class itself. Trade finance has generally been defined as short-term, self-liquidating. So it has its advantages when we're looking at it from an asset class point of view on the financing side. And more recently, when we look at the various cycles, the economic cycles, good and bad, more recent, the pandemic disruption of last year, we find also from an asset class point of view, the resiliency of supply chain finance assets, the various techniques that are used are actually very resilient in terms of defaults, and more importantly, the ability to recover in the event of a default. So, asset class, important, and the ability for us as a bank to offer up end-to-end solutions in the supply chain with respect to liquidity, payment management, and supply chain finance lends itself very well to working with our clients on movement of money and financing.
Thanks very much, John. So resilient asset class and actually something that's probably quite beneficial to corporates. But I guess there's a piece around some of the techniques and definitions of supply chain finance. Christian, can you define some of the key supply chain finance techniques and also just go through how they differ? And I think we'll talk about a few of them. So corporate payment undertaking, payables finance, and receivables discounting.
Yes, so happy to do so. So you already mentioned three key techniques, Deepesh, and indeed, these techniques have been very much in the limelight over the past years, particularly payables finance and also the what you just referred to as corporate payment undertaking. Let me generally answer this question from a global supply chain finance perspective. The Global Supply Chain Finance Forum differentiates between two large categories of supply chain finance techniques. One is the receivables purchase category, and the other one is the loan-based category. In this receivables purchase category, you will find techniques like payables finance and receivables discounting, the two techniques you just mentioned. But this is not all. There is actually also factoring and forfeiting, and we shouldn't underestimate the role of factoring. It's a pretty big market, and currently the public focus is not so much on factoring, but we shouldn't ignore this business. It's very important and it's big. However, the dynamics and the market size we are currently looking at, the market growth, is particularly on payables finance. And of course, there is also a lot of interest on the other technique you mentioned, which is the corporate payment undertaking. This is a different technique, which is very, very similar to payables finance. At first glance, but there are some slight but very important differences. One is that with the corporate payment undertaking, there is no receivables purchase, and that is actually the reason why it's not part of the receivables purchase category, but part of another category we are currently working on. So, in summary, yes, these are the key techniques where you currently have the focus of the public on, but there's a lot more. In fact, there is also a loan-based category with very, very traditional financing techniques like loans against receivables or pre-shipment or distributed finance or inventory finance.
Yes, absolutely. And I think that perhaps that potentially drives some confusion within the industry, and we'll talk about the Global Supply Chain Finance Forum a little bit later. But Stacey, I think there's definitely a need to really get those definitions right and also bring the industry together in terms of partnership. Do you think there's a need for industry cooperation or some of these standard definitions when it comes to supply chain finance, and why is that so?
When a handful of industry players came together in early 2014 to discuss the development of this important product and its exponential growth for the trade business, it was clear that each organization had adopted its own name for the various suite of products. And at that time, the decision was taken to develop standard definitions. Why? A group of subject matter experts from banks, associations, etc., came together to produce a glossary. The growing industry needed baseline nomenclature to allow not only industry insiders to discuss it, but also to facilitate discussions with regulators and investors. The need for a standard terminology was clear, and to this day, SEF stakeholders use these definitions in relevant industry dialogue. We were even able to use these when we began our conversations with the Financial Accounting Standards Boards. So all in all, the objective is to standardize and harmonize the supply chain finance market terminology to make it usable in daily practice by banks and non-banks for global adoption over time.
Thanks, Stacey. And Christian, I guess as the chair of the Global Supply Chain Finance Forum, why was it formed in your opinion? And also I'd like to ask, what has the Global Supply Chain Finance Forum been doing recently?
Yeah, happy to elaborate on that. So Stacey already elaborated on the history of the Global Supply Chain Finance Forum. In fact, in 2014, it wasn't called Global Supply Chain Finance Forum. What we did in 2014 is we sat together in a very small room in London at JP Morgan and discussed what can be done. And then there was a decision, we need to work on these definitions. And I can only say I had the honor of being part of this whole exercise from the very beginning. And the journey we have done since then is indeed quite impressive. So what happened was that we set up a project with a couple of people and created these definitions that were published in 2016 in a 100-page document, which is available, and I have it here in my hand. And these 100 pages, this document was actually the basis for what we today call the Global Supply Chain Finance Forum. We had a very important time in 2016 when we said, okay, what do we do now once the terminology is published? At this point in time, it's just a paper. And if we leave it there, it will be a document which will potentially be buried in the desks of practitioners, but potentially may also be forgotten. So we considered what can be done and then came to the conclusion we need to go public. We need to be more vocal on this, and we need to promote our efforts because they are so valuable. So what we did at that time was we said, well, if you want to be taken seriously, nowadays you need a web page. So we created a web page, and that went live in 2017. And then the next step over all these years was that we wanted to expand our group. And ultimately in 2018, we decided, let's go public, let's enhance our group. And that was when we had our first inaugural meeting as a Global Supply Chain Finance Forum. I took over as a chair at that time. And then we had an immediate agenda of tasks we were working on. Let me quickly highlight salient tasks we have completed since then. We have published guidances on receivables discounting and payables finance. We have been working on a document on rules, ICC rules for supply chain finance. We have, of course, always been very engaged in market issues, whether it be with regards to the accounting discussion, which came up over the past years, or the whole discussion around extension of payment terms, the attention from government on supply chain finance. So we were involved in all these discussions. We gave guidance to regulators, to the accounting bodies, as Stacey said. We have also given guidance to the European Commission. They came out with a pretty big report last year, and the GSCFF was also heavily involved there. So by and large, we are very involved in what is going on in the industry. We of course promote our standards because we deem them as helpful for the industry, not only for the industry but also for any stakeholder who has an interest in supply chain finance, whether it be an investor or a client, a rating agency, an accountant, or a regulator.
Thank you very much, Christian. And I guess talking of bodies and working groups and other committees, Stacey, obviously I've heard of the BAFT Global Trade Industry Council. What about this in respect to supply chain finance?
BAFT and its Global Trade Industry Council had the foresight to organize a group of supply chain finance specialists, experts in the field, to develop how a strong framework for the payables finance program would work. So we're focused very much on the payables finance technique that would address the various global challenges that have been raised and certain examples of product abuses. BAFT felt it necessary to undertake a specific initiative to outline the detailed structure, the roles and responsibilities of each of the stakeholders, the related documentation, and the practical application of the SCF payables finance product. The DTIC felt such a document, now called BAFT's Payables Finance Principles, would provide the industry players, corporate buyers and suppliers, regulators, standard-setting bodies, government agencies, accounting firms, and rating agencies, all of those that Christian has already named, with a stronger, more complete understanding of how the product is meant to work for it to be beneficial to buyers and to sellers. The GTIC recognizes and acknowledges that there are many supply chain finance product market structures and practices, but we reaffirm that those structures should not be called payables finance.
Thanks, Stacey. And I guess, tremendous work there and moving it to present day. Why do bodies such as, FASB and IFRS have an interest in payables and supplier finance? And also, what's BAFT's GTIC done with them?
Since the development of the products way back in 2003-4, industry players have been self-regulating themselves according to a speech that was given by an SEC member at that time. There have been no explicit wording, financial standards for accounting for the product that would have shown up on the books of the corporate users, buyers. So in 2018, the big four accounting firms asked the FASB to review the technique called payables finance, also known as reverse factoring, to opine on the balance sheet and financial statement requirements for the product. Similarly, the IFRS was approached by one of the rating companies with a similar request, kicking off a fulsome product review at each of the US and EU financial standards bodies. Each of the FASB and the IFRS have access to accounting firms, consulting firms, investors, and corporates, but appreciated the assistance of BAFT in joining them in conversations with BAFT members and the key SCF players at the global trade banks. I should mention that each of the FASB and the IFRS are in final stages of reviewing what the disclosure requirements should look like for corporates using these programs in order to provide transparency, which is really an essential issue around the product, minimize liquidity challenges, and offer as much information as available for the investor community.
Thanks very much, Stacey. John, I guess a bit more of a direct question. Does supply chain finance have a bad reputation?
I think the nomenclature supply chain finance has come under some discussion recently with market participants and perhaps high profile bankruptcies on the corporate side. But as Christian said, it's important to note what is supply chain finance, and that umbrella definition encompasses a variety of different techniques, whether it's on the receivable side or the payables side. So to some extent, payables finance has taken what are we doing with this particular product from all participants. And as a result, our job as practitioners is to get out the message in terms of what is payables finance and the benefits to corporates, both buyers and suppliers, as well as funders. So I think there's a lot of work to be done in terms of working with the industry participants in terms of identifying what is payables finance versus some of these other techniques. So that's a tall order. Getting an understanding of what payable finance is versus a receivable finance type program, structures, the documentation, the benefits, why is one using it, all needs to be communicated. And from a corporate perspective, we also adhere to transparency in terms of identifying what programs, particularly payables finance versus other types of programs. So the more transparency within the industry in terms of what is a particular program that's being used to finance the various participants in a supply chain realm is beneficial to everyone. So how does one go about identifying and not being seen, to your early question of, is supply chain finance, does it have a bad reputation? I would say there are some components that perhaps have given us a taint, but payables finance on surface and as practiced by the definitions that BAFT and others and Christian has worked on in the definition books, I think is a very pertinent product, and it actually fits the needs of various constituents in the supply chain and will continue for the foreseeable future as well. There's definitely a need for it. So yeah, that's my summary.
So long-dated future receivables don't count then.
Anyway, there's no definition on that one in payables finance, but that's a good point. And again, it goes back to definitions and what are the right structures and how does it bleed into supply chain finance or payables finance?
Thank you.
I would maybe like to add to John's point that yes, there was recently a lot of talk about supply chain finance. There are certain market events we are all aware of, but I would not per se agree with the fact that supply chain finance has a bad reputation. There is always a risk of bad reputation, and this is exactly our task from an industry perspective, that we educate the market. I believe that most of the observers who seriously observe what's going on in the supply chain finance industry have understood the benefits of supply chain finance. I like the comparison of supply chain finance as a tool. It's a very useful tool, and you can create a lot of benefit for it. Like any other tool, it can be misused. If you have a hammer, you can build a house with it, but you can also smash a window with it. Supply chain finance is not different from that. We have published rules and recommendations, and if you follow these rules and recommendations, you're on the safe path, on the bank side as well as on the corporate side. And what also needs to be seen is there are always outliers. There have been outliers in the past. What is not seen is the vast majority of the business, which is going very well, and the vast benefit supply chain finance, whether it be payables finance, receivables discounting, factoring, or other financing techniques, the vast benefit that is created to buyers and sellers out there in this world. Our mission is to close the infamous financing gap, and supply chain finance is an ideal tool to accomplish that task. So it's actually, supply chain finance in itself shouldn't have a bad reputation, it should have a good reputation.
Thanks very much, Christian, and I think it's kudos to the industry for continuing to innovate and create these products that serve the market challenges when it comes to SME access to finance, the trade finance gap, etc. So let's actually talk about the evolution of supply chain finance. And Christian, do you think supply chain finance should evolve and develop to align with corporate goals? So perhaps things like the BPU or DD, etc.
Absolutely, and I have alluded to that earlier in the discussion. What the global supply chain finance currently is doing is I mentioned there will be a third category, we called it advanced payable. This third category will entail three financing techniques. One is the bank payment undertaking, one is dynamic discounting, and one is the corporate payment undertaking. This is indeed aligned against the needs of the industry, whether it be clients or banks. When you look at the corporate payment undertaking, it is indeed a very smart technique. You save a lot of effort. For example, when it comes to onboarding of sellers, yeah, you can easily finance or onboard hundreds of sellers without too much KYC effort. However, there are also certain limitations. You do not purchase a receivable. That is why it's a separate category. And when you look at on the accounting side, I'm not an accountant, but according to my experience, the question whether a receivable is purchased or not is a key criteria for the question whether the payable in the book of the corporate is regarded as a trade payable or as a bank debt. From a supply chain finance perspective, we cannot ignore the fact that there is a demand for other techniques. And that is the reason, and the trigger, in fact, was the discussion on the corporate payment undertaking. So we cannot ignore that demand, and that is why we came up with this additional technique description. The other techniques are similarly important. Dynamic discounting, for example, is also a very smart technique. We haven't reflected it in the initial version of the standard definitions because we thought, well, it's not funded business. It's just something between the buyer and the seller, where potentially a service provider calculates a discount price and then the buyer just pays earlier. However, over the past years, dynamic discounting has become more relevant. We also see cooperations between banks and fintechs who offer dynamic discounting. Dynamic discounting is less regulated, and it absolutely makes sense to come up with smart offerings to corporates who maybe even want to use both, depending on their working capital needs. Lastly, the bank payment undertaking addresses networks like, for example, we heard a report earlier on the Trade Information Network. And this goes into this whole space like dynamic discounting, deep tier financing, where you have a bank payment undertaking and it can be financed by someone else because you have only adopted the bank and you know this is going to be financed. So it's a great opportunity also to support another seller or buyer with liquidity. So in summary, yes, definitely, we need to take into account the goals of the corporates. We need to take into account the dynamics which are happening in the market, and that is the reason why we are also developing the standard framework of the Global Supply Chain Finance Forum. In terms of timing, where are we? We have recently published the technique description of the corporate payment undertaking. We have finalized our first draft for our finalized draft for the dynamic discounting. This is currently under review, and we are just initiating the work on the bank payment undertaking. I expect that the bank payment undertaking should be available maybe end of the year or beginning of next year, and once that is done, we will take a general look at the whole main document, the standard definitions, and then update this document with a new category that's a bit more work, more on the editorial side, but it's important, and ultimately there will be a second edition of the standard definitions, which will take into account all these techniques, all the three categories, and will have a much more comprehensive view on the market.
Thanks, Christian. John, do you have anything to add? Are there other types of supply chain finance do you think that should be developed perhaps in the pre-shipment or PA finance space?
So look, a lot of work is being done on pre-shipment PO finance. Christian mentioned the Trade Information Network, corporate payment undertaking. How do you make it easy for the participants to get the financing they need? In areas of risk management, there are discussions when you look at deep tier finance. Can an anchor client help support the lending decisions of a financier in making it palatable to expand the financing needs, to meet the trade finance needs across the supply chain. A lot of work is being done. The technology being put forth over the last couple of years with respect to blockchain, with respect to what's being done on the Trade Information Network, allows for easier, perhaps, abilities to get comfortable with the underwriting and or the financing. So when looking at it, I think over the next couple of years, whether artificial intelligence, the blockchain to reduce fraud, to perhaps give better insight into the lending decision process, all bodes well for supply chain. So though we've talked about payables finance with a buyer-backed proposition from an asset class, I've mentioned it's very liquid and many participants are comfortable with it. Getting into some of the other areas on the financing side, more understanding of where the risk lies and what's the recovery methodology. But I think, pre-shipment finance, deep tier finance, all terms being used. A lot of technology vendors are looking at it with respect to how blockchain can help facilitate some of these discussions. A variety of fintechs are out there, none of which have gotten critical mass to help grow these new products, or not necessarily new, but perhaps enhanced products. And I think we'll see that in the coming years as more of these start to take off.
Thanks, John. And I guess that builds on the previous room on blockchain for trade and supply chain finance. So I know a lot of the participants can watch that video. Let's talk about the other big theme of this conference, which is sustainability and ESG. And John, in your opinion, can supply chain finance help corporates and banks align to their ESG strategies? And can supply chain finance be used as a tool to drive ESG?
So my opinion is absolutely. And we have seen it with our corporate clients asking for perhaps how can their own supply chains, if you think about it on the payable finance side, a large corporate very much focused on sustainability or ESG aspects, not only on the environment, but how to properly address their vendors in terms of doing the right thing from a social perspective as well. So we are seeing an adjunct in terms of using their supply chain finance programs to help support their own initiatives in terms of whether it's environmental or on the social side. So we will see a lot more engagement in terms of developing that financing technique for the betterment for vendors to be managed better in that respect. So we've seen a lot of corporates announce supply chain finance ESG initiatives. We'll continue to see that. I think it's the right thing to do, and a lot of benefits on that side. And it's complementary in terms of what, at least on the payable finance side, and more will be done in terms of longer term with taking that asset class and getting enough volume, and then being able to perhaps distribute those ESG friendly assets in addition to the better in terms of the quality of that asset, and tag on an ESG element to it. It actually would hopefully broaden the ability to expand the financing throughout the the supply chain.
Thanks very much, John. I think we have time for a couple of questions. So if any participants have any questions, please put them through in the chat. And actually, I'm going to ask a fairly provocative question from looks like our good friend David Gustin. And over to you guys for who wants to answer it. Is there any large company that rolled out payable finance programs without extending terms?
I can answer.
We all want to answer that question when you're all jumping in. Go ahead, John.
You can all answer.
Hey, the answer is yes. So one of the propositions, and it goes back to the accounting side, how do you help your supply chain? So we've talked about ESG potential opportunities, but the other aspect is to give liquidity to suppliers that are in need of it at perhaps a lower cost than they can find elsewhere. So though it is beneficial perhaps to extend terms, there's also a benefit, particularly with supply chain disruptions, to ensure the stability of the supply chain. So we've seen corporates announce that they're going to provide supply chain finance initiatives without raising and or extending terms. So that is certainly a benefit that we've seen in the market, particularly over the last year.
I'm going to jump in and just add one point. Sorry, John. I think it's important to note, I would say, have we seen it done without term extension? I think we see it done with respect to what are the industry standard terms for a specific product. Some organizations, some corporates are providing longer tenors and some shorter. So I think there's been an evening out based on what the standards are, the standards for the products themselves. So that would be my thought. I don't know, Christian, if you have something to add.
Okay. Let me also share some considerations here. So first of all, when you look at the question of extension of payment terms, this is a very isolated view. You have to see the full picture. Even if a payment term is extended, it may still be beneficial for the seller, this extended payment term, because the financing conditions will be so attractive as compared to a standard receivables purchase or factoring deal that it's still fine. So in the end of the day, a payable finance setup, if it's set up appropriately, it's a win-win deal for both parties, for the buyer and the seller. The buyer may pay a little later, the seller will still get their funds early, but they will pay less than with the old payment terms, even if that was shorter. That is one argument I would like to bring here. The other point is that you also need to take into account the motivation why a buyer is introducing a payable finance program. They may not at all be interested in optimizing their working capital. They may simply be interested in stabilizing their supply chain. They may have strategic sellers who they just want to support because their products are so important to the buyer that they cannot afford the supplier going out of business. So they want to support them with their capital strength. And in that case, there is absolutely no reason to extend a payment term. They are just helping their seller with their rating, and that's it. So I would say, yes, if you go out there, you will definitely find such programs. It will be difficult to name names due to banking secrecy, but I'd be pretty sure that you will find such programs out there.
Thanks, Christian. Many benefits there. I guess in terms of in the wake of the recent market events, how are bankers adapting as they consider working with non-bank supply chain finance providers and fintechs? John, can I pass this question over to you?
Look, there's a lot of opportunities to work with fintechs in the supply chain or supply chain finance. So looking at the propositions, what's the offering, what technology, what techniques do they bring to the equation to support clients? So I see the world is evolving. Many fintechs are out there with unique solutions that, coupled with the bank's ability to finance the flows, actually brings forth a better proposition to our corporate clients. So there's a variety of different folks out there, and we look at all of them and to see how they can help support our clients and with an overall better value proposition.
Many of the corporates are in great need of support for the onboarding of the suppliers, which can be a challenge, as we heard earlier today. Sometimes there are 1,000, sometimes there are hundreds. So I believe strongly that the fintechs, many of whom have come up with very specific onboarding techniques that are very helpful to a bank that's doing a supply chain finance program.
Yeah, just to add to that, Stacey, with that in mind on the onboarding process, the new techniques, whether it's corporate payment undertaking and or providing dynamic discounting or some combinations of the above. That also, it's beneficial to expand the liquidity access to SMEs and others, but also looking at it from the accounting side and how one should look at it from either accounting or on the risk side as well. So those are some of the things that, as the markets evolve with fintechs, we look at to make sure that addressing one need is not compromising potential concerns on the other side of the equation as well.
Thank you very much, John, Christian, Stacey. I think that's about all we have time for, but a really great session from you all. So thank you, and thanks very much to BAFT for hosting a fantastic conference. Take care, everyone.
Thank you.
Thank you.